What's the best way for beginners to start investing online with just $100? Seriously, this is one of the most common questions I hear. Because if you're new, you're probably thinking, look, I don't have thousands. I don't have some massive budget. I've got $100, maybe $200. What can I do that actually makes sense? And what's just hype? So instead of giving you a vague answer like, it depends, I wanted to test it in the most real way possible. 4 years ago, I decided to answer this by doing a simple experiment. I took exactly $100 and I invested it into 5 different things. 5 options you can do from your laptop. No special access, no fancy setup, just normal, beginner-accessible investments. And today, I'm going to compare the results from those 5 investments and try to answer the question once and for all. What's the best way for a beginner to start investing online with only $100? Now, before we jump in, quick reminder, I'm not a financial advisor. I'm not telling you what to buy. I'm just sharing my own results and what I've learned. And you should always do your own research, because everyone's goals, timelines, and risk tolerance are different. Alright, let's set up how we're judging these options. The 5 categories we're using to judge each investment. We're going to score each one across 5 categories. 1. Learning curve. How long does it take to understand what you're doing? Like the basics, the rules, the common mistakes? Ideally, you want that learning curve as short as possible, especially as a beginner. 2. Passive income potential. How much money can the investment generate for you passively while you still own it, without you needing to sell it? Think dividends, distributions, income streams. 3. Tax efficiency. Are there legal tax advantages or account structures available for that type of investment that could help you keep more of what you earn? 4. Risk level. How likely are you to lose money? And how intense is the volatility? How much does it swing up and down? 5. Results. This is where I reveal what happened after 4 years, the percentage return, and what that $100 is worth today. Okay, let's start with the first investment option. Option 1. Individual stocks. Alright, first up, individual stocks. This one is exciting because you're buying a piece of a real company you believe in. You're not buying the market, you're investing in a specific business. And it can feel really motivating because you're basically saying, I think this company is going to grow, succeed, and become more valuable. But here's the truth. Successful stock picking isn't a guessing game. If you want to pick individual stocks well, you need to understand what you're buying. Learning curve high. For learning curve, I'm rating individual stocks as high. Because to be good at this, you have to dig into the fundamentals of the company. You're looking at things like the financials, who's leading the company, whether the brand is strong, how the business actually makes money, and what might cause it to win or lose over time. When I invest in individual stocks, I'm looking through income statements, balance sheets, and cash flow statements. And when I buy a stock, I'm not thinking short term, I'm thinking long haul, 2 to 10 years. Now, if you're new and that sounds intimidating, you're not alone. That's why one of the best beginner moves is to practice using an app that offers a demo account. A demo account means you can trade with fake money. You can learn how the platform works, how buying and selling works, how price movements feel emotionally, without risking real cash. Because let's be real, the market has a way of teaching you lessons. The question is whether you want those lessons to be expensive. Passive income potential. Good. For passive income potential, individual stocks can be good, because there are 2 ways you can make money from a stock. 1, price appreciation. If the price goes up while you own it, you can sell it for more than you paid. 2, dividends. Dividends are regular payments to shareholders. Not all stocks pay dividends, but if they do, you can earn money without ever selling the stock. That's basically passive income. Tax efficiency. Great if you use the right accounts. For tax efficiency, individual stocks can be great, depending on where you live and which accounts you use. The original content gives examples. In the UK, there are stocks and shares ISAs. In the USA, there's something similar like a Roth IRA. Different names, different rules, but the idea is similar. The right account can act like a shield around your gains and reduce your tax burden. And just to be clear, I'm not a tax advisor. Rules vary country to country. Always research what applies to you. Risk level, high. Now for risk, this is where individual stocks get serious. The risk level is definitely high, because when you invest in individual stocks, you're concentrating your money into a small number of companies, and if those companies struggle or fail, you can lose a lot. If you put all your money into just a few companies and they crash, it can be brutal. There's a story in the script that illustrates this perfectly. Back in the dot-com boom, some people picked a few great stocks and made a lot of money quickly. But when the bubble burst, some of the other companies people owned went out of business completely. Even if you ended up okay overall, it shows how risky it can be, especially when you're concentrated. Results. The $100 experiment, random stock pick. Now let's get to the results, because this part is honestly the best lesson. Instead of carefully choosing a stock, the experiment chose one randomly. They selected 20 stocks, then threw a dart at a board. Wherever it landed, that's what they bought. And to make it even more random, they put on a blindfold. The dart landed on Samsung. 4 years later, that $100 investment was worth $67.66. And yes, there were dividends, but it was basically nothing, around 10 cents. So the total came to $67.76. That's a negative 32.34% return. And this perfectly shows how hit or miss individual stock investing can be if you're leaving it to chance. Because that dart could have landed on Apple, Microsoft, or Nvidia. Same $100, same time frame, totally different outcome. In fact, the script compares it. $100 in Apple would have been about $70, $100 in Microsoft would have been about $188, and Nvidia, during its boom, could have been about $908. So the takeaway is pretty clear. You can't just leave individual stock investing to luck. You need strategy, you need research, and even then, the market can still surprise you. If you're a beginner, individual stocks can be fun and they can be rewarding, but the learning curve is higher and the risk is higher. So if you're going to do it, practice first, start small, and don't treat it like gambling. Alright, that's option 1. Now let's move to option 2, something that sounds complicated, but is actually a pretty simple concept. Option 2, REITs, real estate investment trusts. Second is a REIT, a real estate investment trust. A lot of people hear real estate and immediately assume you need huge money, mortgages, down payments, agents, paperwork, and yeah, if you're buying physical property, that's often true. But REITs give you a way to invest in real estate without buying a property yourself. Here's the simplest way to picture it. Imagine your friend collects $100 from 3,000 people. That's $300,000 total. Then they use that money to buy a property, rent it out, and share the rental income with all 3,000 people who helped buy it. That's basically what a REIT does. Or think of it like this. You own the front door, someone else owns a window, other people own the bricks, and together, everyone owns the whole property and shares the profits. Learning curve. Moderate. The learning curve here is moderate. Getting started with REITs is much easier than buying physical property. You don't need a huge down payment, you don't need a mortgage, you don't need to deal with agents or legal paperwork, but you still need to understand what the REIT owns. Some REITs own office buildings, others own shopping centers, others own apartments, hotels, warehouses, and they make money through rent. So you still want to learn the basics. What kind of properties are these? How stable is demand? Are the leases long-term? How well managed is the REIT? Passive income potential. Great. For passive income potential, REITs are often great. They're well known for paying relatively high dividends. The script explains it like this. In many setups, REITs have rules that require them to distribute a large portion of profits to investors, often referenced as at least 90%. So as long as the REIT is performing well and the properties are rented out, you can earn a steady stream of passive income. And because many commercial tenants sign long-term leases, the income can be relatively stable most of the time. Tax efficiency. Great, depending on country count. For tax efficiency, REITs can be great, depending on where you live. The script gives the UK example. Holding REITs in a stocks and shares ISA can help shelter profits and dividends from tax. So if your country has similar account structures, REITs can become more attractive. Risk level, medium. For risk level, REITs are medium. They're often less risky than buying a single property because they spread risk across multiple properties. But they're not risk-free. If the real estate market takes a downturn, or if the REIT struggles to keep properties rented, you can see dividends drop and the investment value drop as well. Results. The $100 experiment, REIT, now results. In the experiment, the REIT investment was worth $98.59, so on price alone that's a small loss of about negative 1.41%. But dividends changed everything. Over 4 years, dividends totaled about $11.93. So overall, the investor was actually up $10.52, which is about 10.52%. And the explanation was simple. The REIT likely underperformed because it was tied to commercial real estate that struggled during the pandemic period. But thanks to dividends, it still ended up positive overall. So REITs are kind of like a middle ground. Not as exciting as the winner-takes-all stock stories, but potentially solid for people who like income and want real estate exposure without buying a building. Alright, option 2 done. Now we go to option 3. And this one can look insane on paper. Option 3. Cryptocurrency. Third is cryptocurrency. The simplest way to describe it is, crypto is digital money that isn't controlled by a government or a bank. Coins like Bitcoin and Ethereum run on blockchain technology, which makes transactions secure and transparent, and extremely difficult to counterfeit. Crypto has created massive wealth for some people. Bitcoin is often described as one of the best performing assets of the last decade, but the flip side is just as real. It's highly volatile. People have lost fortunes too. That's why the script describes crypto as part investment, part speculation, and not for the faint-hearted. Learning curve, moderate. The learning curve is moderate. Crypto sounds complicated, but when you break it down into basics, it becomes manageable. First, you need a wallet where you store your crypto, like a digital piggy bank. There are different types. Online wallets, easier to use, but you need strong security. Offline hardware wallets, generally safer because they're not connected to the internet. Next, you need an exchange to buy and sell, like Coinbase or Binance. These platforms make trading simple, but you want to choose trustworthy exchanges and be careful. Then there's tokenomics, just understanding supply and demand. Bitcoin has a limited supply, which is why people call it digital gold. Passive income potential. Moderate, but risky. Crypto doesn't pay dividends like stocks or REITs, but some people try to earn passive income through things like staking, locking crypto to support the network and earn rewards. Yield farming, lending crypto to earn interest. These can generate returns, but they come with extra risk. The coin could drop, the platform could get hacked, the yield could disappear. The script also mentions a more conservative approach, just holding crypto safely, rather than chasing yield. Tax efficiency, poor. For tax efficiency, crypto is rated as poor. In many places, swapping one cryptocurrency for another can be a taxable event, and staking rewards can be taxed as income. Also, crypto often doesn't fit neatly into the same tax-advantaged accounts used for traditional investments. Risk level, very high. Risk level is very high. Crypto is one of the most volatile investments out there. Prices can soar and crash fast, and scams are a real issue. If someone hacks your wallet or tricks you into sending coins, there's often no way to get them back. Results. The $100 experiment Bitcoin. Now for results. In the experiment, $100 invested in Bitcoin turned into $652.24. That's a 552.24% return, which is wild. But the script stresses this. That kind of growth is not typical. Bitcoin has had an incredible run, but many cryptocurrencies don't perform like that, and plenty lose value entirely. So crypto is high risk, high reward. If you go into it, you need to research and manage risk carefully. Alright, option 3 done. Now let's move to option 4. Gold. Option 4. Gold. Gold is one of the oldest and most trusted ways to store and protect wealth. It's often called a safe haven because people use it to protect wealth during uncertain times, when inflation rises or when the economy feels unstable. Learning curve, low. The learning curve is low. You have two main options. 1. Physical gold bars and coins. The script also mentions something important. Gold jewelry isn't usually a great investment because you often pay extra markup for craftsmanship, so the investor prefers gold coins. Just remember, physical gold has storage and security considerations. 2. Gold ETFs. Funds that let you invest in gold without physically owning it. Easy to buy and sell with a few clicks. Passive income potential. Zero Gold has zero passive income. No dividends, no rent, no yield. It's purely a store of value. Tax efficiency. Good, but depends. Tax rules vary depending on what you buy and where you live. Some gold products may have special treatment in certain countries, and ETFs can sometimes be held in tax-advantaged accounts. Risk level, medium. Gold is often seen as safer, but it still moves up and down, and it doesn't have the same growth potential as stocks or crypto, so there's an opportunity cost. Results. The $100 experiment, gold. In the experiment, $100 in gold became $140.10. That's a 40.1% return. Solid, steady growth. Less exciting than Bitcoin, but stable and dependable. Alright, last one. Option 5, index fund. Fifth is index funds. This is where things get really beginner friendly. An index fund lets you own a tiny piece of many large companies at once, like Apple, Microsoft, Amazon, bundled together. It's basically a basket of stocks that mirrors a specific index, like the S&P 500. So instead of betting on individual companies, you're investing in the overall market. Learning curve. Low index funds have a low learning curve. Unlike individual stocks, where you're digging into financial statements and leadership teams, index funds are passive investments. You don't have to pick and choose stocks. They're already bundled for you. Getting started is simple. You buy the fund, and then you sit back and let the market do the work. Passive income potential. Moderate. Passive income is moderate. Index funds don't pay high dividends like REITs, but many companies inside the fund pay dividends. Those dividends may get distributed to you or reinvested depending on your choice. The main focus is long-term growth, and dividends are a nice bonus. Tax efficiency. Great tax efficiency can be great if you use the right accounts. ISA in the UK, Roth IRA in the USA, and so on. The idea is you can potentially avoid taxes on dividends and capital gains inside those structures. Again, depending on where you live. Risk level. Pretty low, relative. Risk level is pretty low compared to individual stock picking because index funds are diversified. Instead of putting all your money into a few companies, you spread it across hundreds or thousands across different industries. The script also mentions that historically the S&P 500 has delivered average annual returns around 8 to 10% over the long term. It can go up and down in the short term, but over 10, 20, 30 years, it's one of the safest ways to grow wealth. Though of course it still comes with risk like anything. Results. The $100 experiment index fund. In the experiment, $100 invested in an index fund became $179.57. That's a 79.57% return. And that result shows why index funds are such a great option for most investors. Simple, low cost, and consistently solid over time. Final wrap up. So what's the best for beginners with $100? So now the big question. Based on all 5 options, what's the best way for a beginner to start investing online with just $100? If you want the most balanced answer for most people, something that's simple, diversified, and historically reliable, index funds are the best starting point. They're low effort, low learning curve, and they give you broad market exposure instead of forcing you to gamble on a single company. Now, that doesn't mean the other options are useless. The script makes a point I agree with. Diversification matters. So a realistic approach for a lot of people is build your foundation with index funds. Maybe add REITs for income. Maybe add a little gold for stability. Maybe add a small slice of crypto if you understand the risks. And maybe try individual stocks if you genuinely enjoy researching companies. That way, you balance growth, stability, and risk. But the most important lesson, more important than which investment won in this 4-year window, is this. Start early. Even small amounts like $100 can grow into something meaningful thanks to compounding. Time is your best friend in investing. The sooner you start, the sooner the math starts working for you. And that's the whole point. You don't need to be rich to begin. You just need to begin and stay consistent long enough for compounding to show you what it can do.